I'm Angie Elliott with the Wichita Chamber, and I'm really pleased to be able to provide this great informational topic. And actually, this topic came up at our Small Business Committee meeting a month or so ago, where we had some of our business owners telling us that they've really enjoyed being able to take advantage of the employee retention tax credits, and decided we needed to get some more information out there for our members to make sure they are taking advantage of it as well. So welcome. Bryan Elmore is our speaker today, and he is a CPA licensed in Kansas. He has over 15 years experience helping clients with tax compliance and planning, and he keeps clients out of trouble and works to reduce their tax bills as much as possible. He has worked with public accounting firm KSHD, a Wichita-based CPA firm, for 5 years, and specializes in tax incentives such as R&D tax credit, work opportunity tax credit, and tax credits that came out of the CARES Act. So he's been very busy lately. Bryan, we really thank you for joining us today. And I'm going to go ahead and turn it over to you for the remainder of the program.
Okay, thank you, Angie. Let me share my screen. Second. Well, I thought I had this. Okay, is that okay, Angie?
Yes, looks great.
Okay, yeah, so as Angie said, with Koch Siedhoff Hand Dunn, I know in Wichita, KOCH is Koch, but it's pronounced Cook, and I wanted to say hello, and the first thing I thought of hello was the Lionel Richie song. I don't know why it just came to my head, but maybe this will make it more memorable for you. We're located at 13th and West Street. It's our only location. We have about 25 professional and paraprofessional staff, and we've been around in the same building for 40 years or so. And we offer everything from tax services, consulting, audits, reviews, things to get you in compliance. And we also get involved with mergers and acquisitions also. So this is a great topic. The employee retention tax credit came out with the CARES Act. Let me advance my slide. Came out in the CARES Act, which I think the government came up with CARES and then came up with, well, what does this acronym mean? So it's the coronavirus appropriations. Anyway, it doesn't make any sense, but they made the acronym work. So it came out in March 13th of 2020, and the basics of it is that it is a wage-based credit for $5,000 per employee for 2020 and $7,000 per employee for 2021. And it's claimed on IRS Form 941, which is what you file with the IRS quarterly for your payroll taxes, which is unusual because most tax credits end up on either a business tax return or an income tax return. This is kind of a new procedure for the IRS to put it on the 941, which is an advantage because the 941 is filed quarterly as opposed to annually for your business or your income tax returns. And there's also another form available that you can claim it on, Form 7200, which is also a new form from the IRS. So you could get an advance payment on this if you qualify. So just to give you an idea of the CARES Act interactions and this whole mess, I don't want to say mess. There's a lot of opportunities. And this slide kind of diagrams how the interactions between of course the Paycheck Protection Program, which was very popular and marketed extensively by SBA, by practitioners such as myself. And then you also have the economic injury disaster loans, the EIDL, which was from the SBA. And then you've also got things like NOL carrybacks, which you can carry back 5 years. And then hidden in here is the employee retention tax credit. So you can see all the interactions. You take one, you can't take the other. You take one, you got to reduce the benefits of the other program. And they cranked this out in record time. All of this interaction, minimum in a normal tax year would be a year, 18 months of going back and forth and haggling, but they cranked this out in 2 weeks to a month or so. So there's a lot of it came out, and a lot of our clients were asking, what can I qualify for? I heard there's a program where it's forgivable. And so we were rushing around trying to figure out the rules that were really vague. And so it's been a learning curve, but of course the PPP program has gone away, and I really want to spread the word about the employee retention tax credit because it's a great program that's available towards for the end of the year. So let's look at the history of the ERTC. So it started out with the CARES Act, and if you look at bullet point number 1 there, if you received a Paycheck Protection Program loan, you could not get the ERTC when it first came out. So of course, taxpayers, our clients, wanted the PPP loan because it was forgivable, for one thing, and it was non-taxable. So that's why it was very popular. But if you did get the ERTC during 2020, it was limited to a total of $5,000, capped at $10,000 of wages paid. So you pay somebody $10,000, you would get a 50% credit or $5,000. So it was capped at $5,000. Then in December of 20, President Trump signed the Consolidated Appropriations Act, which is weird to me because most of the time they have cool names associated with them. So it's hard for a Congress person to vote against it, kind of like the Patriot Act. Why are you going to vote against the Patriot Act? So it's just weird, the Consolidated Appropriations Act. Anyway, so it allowed taxpayers to take both the PPP and the ERTC. So that kind of opened up, of course, the population of people that could take it. Now, when under that bullet point for Consolidated Appropriations Act, cannot double dip means that you're going to use your PPP money for wages. You can't get the ERTC money as a credit and pay those same wages. So it's really after the PPP forgiveness period has ended, then ERTC can kick in. That's why I put there, you can't double dip. And under the Consolidated Appropriations Act, it's up to 70% of wages up to $10,000. So it went up to $7,000 tax credit per employee. And then in 2021, President Biden signed the American Rescue Plan Act. ARPA is what it's called, and it effectively extended the ERTC to the end of December. So it really opened up a lot of opportunities for clients. So this reminded me of a joke. It's kind of a dad joke, but why isn't a koala a bear? Because he's not qualified. Sorry. So what are the qualifications? There's two. You have to be either shut down by the government, a government order, federal, state, local order, or you had to have experienced a drop in quarterly gross receipts. So let's take a look at that. So the qualifications, the first one, shut down by a government order, the United States Treasury came out with a whole, it was a long regulations, which means that they had explanations of what it meant by shut down by government order, because everybody was affected by COVID, because you had to either have social distancing, you had to have institute or implement PPE for employees and possibly customers. So, and that was by Sedgwick County's order. So everybody was affected. So what did it mean to be shut down by government order? And it wasn't until January of 21 where we got real clarification on that. If you think back to that mess of this interaction, we were just dealing with a lot of definitions, and it's up to the Treasury to define those. So that's what they did. That's what they did in December of 21. So let's go through that. The first bullet point is you could be permanently closed down. For instance, the YMCA or Genesis or other health clubs were shut down. So they would automatically qualify for the ERTC for the quarters that they were shut down. So the Sedgwick County order went into effect. I've got, we'll open up the Sedgwick County order by Dr. Menz in a few minutes, but so that the YMCA would automatically qualify. Or you could have a partial shutdown. And I put in here one of Wichita's favorite restaurants, the Monarch, where their dining room might have been shut down, but they could still have carryout. So a partial shutdown, and they would automatically qualify. I put Costco on here. You know, my wife likes to go to Costco with my mother-in-law, and I don't know, it's a once a week trip, which I don't know, my eyes would glaze over if I mean, the hot dogs are great, but anyway, they had a company policy of only letting a certain amount of individuals in. So that was a company policy. So sometimes, you know, you would see people wait in line for other people to come out so they could go in. They were not affected by a shutdown because they were deemed an essential business. So even though they were affected, a government order they couldn't qualify under the government order shutdown because they were to remain open. So let's look at the Sedgwick County order. I know it says draft on here, but it was issued May 23rd, and I got this from the Sedgwick County Health Department website. So if we go through here, we'll see that right here, all businesses are required. They basically took the stance that everybody's shut down except for essential businesses. And then it goes on to explain what an essential business is. This is kind of a weird requirement, because it basically, they should have said, okay, these are the non-essential businesses, because if you look at this list, it's, you know, of course they talk about social distancing, but if we come down here to essential businesses, you've got, of course, healthcare, grocery stores. So it kind of goes through how the businesses that need to stay open so that people can still live their lives. So it's a big list of businesses that were required to be remained open, and therefore it's very difficult to apply to meet the standard of being affected by the government shutdown. Um, Gas stations, hardware, accounting services are on here, but then you'll see restaurants are only available for drive-through or delivery, so that you can't consume the food on the premises. So restaurants are a great candidate for this. Of course, gyms are not listed on here, so they automatically deemed non-essential, so they would be closed. So the standard for a government shutdown is difficult. Most of our clients, unless they were in the hospitality industry, hotels, they would be affected. Um, so that's one qualification. So if you don't meet that standard, which is difficult, then you go on to having I put on here year over year, but basically, sorry, you're going to compare for 2020. You're going to compare each quarter of 20 to the same quarter in 19. So as an example, for instance, you can see here second quarter sales of 19 were 500,000. And then in second quarter of 2020, things take a downward spiral. So you have a 60% decrease in sales. So automatically you would qualify. So you would qualify in this case for the second quarter, and then you would continue to qualify until your gross receipts get up to 80% compared to the same quarter in 19. So it's kind of like you have a big dip in sales in this instance in second quarter, and then sales slowly go up, you know, third, fourth quarter. So as long as you stay at a 20% dip quarter over quarter, then you're still going to qualify. And then for 21, under the ARPA rules, you only have to have a 20% decrease in sales, but your base is still of 19. So you're going to compare in this instance first quarter of 19 to first quarter of 21. And you see that there's a decrease of 37.5% in your sales. So you would meet the qualifications. So 21 is easier to qualify for than 20. So let's go through an example. I don't know what this cat is saying. Maybe, you know, show me the money, or I got $1. I don't know. I just thought he was very excited about the dollar. So let's go through an example. For 2020, let's just assume that you qualify. So 50% of your wages to a maximum of $10,000. But it's you can only claim that for one quarter only. So for instance, and you can't, remember I said you can't double dip. So let's just say first quarter wages for 2020, that's when you would have got your PPP money probably around then too, around first quarter, maybe second quarter. But so you have wages, but those wages were paid with PPP money. So your eligible wages for ERTC go down to 0, no credit. So let's just say that moving on to second quarter, you have the same amount of wages, but your forgiveness period or your forgiveness period is ended. Maybe it's 8, 24 weeks. I've had one client that had it forgiven by second quarter. So now they're in ERTC territory. So no money, no wages were paid with PPP money in this instance in the second quarter. So now you have $250,000 of eligible wages limited to $10,000 for that quarter for each employee. So let's just assume that everybody was paid $9,000 total for the quarter. So all the wages qualify. So your maximum credit is going to be $125,000. So that's for 2020, you're done. You can only claim it in one quarter. So as soon as an employee reaches $10,000, really for the year, you're going to look at it quarter by quarter. Then you're maxed out and you're done. But that's a nice size credit that's available. So let's look at 2021. So as I mentioned, the credit goes up to 70% of wages, and it's per quarter. So and you only have to have a 20% dip in your sales. So let's just say that you qualify first quarter of 21, maybe you got the second round of PPP. So then in that first example, the first table there, you wouldn't get any credit because you used the wages with PPP money. So let's just say second quarter goes around of 21 and your PPP forgiveness period has ended. Now your credit goes up to 175,000, and that's per quarter. So you can pay somebody $10,000 per quarter as opposed to per year and get a 70% credit for the quarter. So in the third table, you can see the example of, again, same wages, same credit amount. So it's an unbelievable program that needs to get more attention with the public. So this little guy, he's got more month than money, so he needs his wages. So how do you quantify, or what goes into the wages? So eligible wages is anything that you pay in cash to an employee. So that includes, of course, wages, tips, commissions, bonuses, vacation pay, sick pay, all of that gets rolled up. But there's also, if you look at the 2 bullet points, this is a really great because you can include the employee's portion of health insurance that's paid. So you can add that back in. And let's just say that you had to furlough employees and you continued to pay their health care or health insurance. Even though you didn't pay them wages, you can still include the amount of healthcare premiums that you paid on their behalf. So it's of course it's the cash wages, but then when you add the healthcare costs, you can really boost up the wages that qualify. So of course you're waiting on the edge of your seat for me to get to, well, what's the interaction between PPP forgiveness and the ERTC? So just hold on a second, I'll get to it. And I apologize in advance for this slide, but it has a lot of great information on it. This came from the Treasury regulations that I mentioned that came out in January that gave a lot of definitions of what does it mean to be shut down, what does it, what's a qualified employee, things like that. But let's just say that this is kind of a planning opportunity. And I don't know, you might want to talk to your banker if you've already submitted a forgiveness application for your PPP money. But there's three examples here that will help you maximize this credit, and in interaction with the PPP money. So on this first example, the employer A received a PPP money in the amount of $200,000, but they also had other eligible expenses. You know, you can spend 40% of your PPP money on rent, utilities, loan payments. So you don't have to spend it all on wages. But this particular employer submitted, if you look at that second paragraph under the first example, they submitted their loan applications just reporting $200,000 of wages, and they didn't include the $80,000 of eligible expenses. So in this case, you can't, even though you've paid, in this instance, you have other eligible expenses that you didn't include on your forgiveness application. So the IRS is saying you've made an election to say all the PPP money went to wages and nothing else. So now you're in a double dip situation. So during your forgiveness period, you can't apply for the ERTC. So let's look at the second example where you have you got a loan for a PPP loan for $200,000, but you put on your forgiveness application $250,000 of qualified wages. So now you're going to get the loan forgiven of $200,000, but then because you reported $250,000 of wages that were paid out during your forgiveness, then the extra $50,000 could qualify for the ERTC. So that would be in 2020, that would be a $25,000 tax credit, just because you feel of the way you completed your forgiveness application. The IRS is saying, okay, so we have record that you have $200,000 of PPP, but you had $250,000 of wages that were paid out during the forgiveness period. So you're saying there's $50,000 available for another benefit, which would be ERTC. And things get a little weird with the third example here. So employer C received a loan for $200,000, which they reported as $200,000 on their forgiveness application, but they also reported $70,000 of other eligible expenses, which could be rent, utilities, to keep the business open, for a total of $270,000 of expenses. So you would think, okay, so 270, so only 70,000, but you have effectively, according to U.S. Treasury, and which is what the IRS has to go by, you are saying that 130,000 is eligible for the ERTC because you reported $70,000 of expenses. So they'll bring the qualified wages down to 100, in this case 130, and then the difference between 130 and 270. So you can claim, you can claim 130 for the ERTC. Hold on, I'm just reading this again. See, this is so. Back to 130 of wages for the ERTC. Okay, I'm sorry. So you can claim that just the 70,000. I stand corrected. 70,000 of the of wages for the ERTC. So essentially you're reduced because you've only had to spend 130 on wages for PPP because you have you reported $70,000 of eligible expenses. Then they're saying that you made the election that you're just going to maximize the PPP money on wages up to 60%, and then 40% could be used for the ERTC. So that's example 3. And that came from the regulations. And I know that's a little confusing. And you would need to, if you've already submitted your forgiveness application, you could, if it hasn't been forgiven yet, maybe you could resubmit your forgiveness application if you wanted to take advantage of both programs. So then you would essentially maybe claim more wages. If you paid more wages that exceeded your PPP, or the easiest thing would be to include more eligible expenses, even though you actually didn't use PPP money for it, because then they're going to reduce your PPP money by 40%, and then, I'm sorry, by 60%, then you can use 40% for the ERTC. It gets a little convoluted. So what's the tax ramifications? And of course, President Nixon wanted you to pay your taxes so you don't get into trouble. So, you know, do as he says, not as he does type of thing. So the downside is that unlike PPP, the ERTC is taxable. It kind of goes along with the double dip theory that, well, not theory, but law. You can't take a credit for expenses that you're deducting. So the amount of the ERTC credit, you need to reduce your wages, the deduction of your wages, by the same amount, which would effectively make it taxable. So for instance, if your wages were $1 million, you got $200,000 of ERTC. Instead of deducting the $1 million, you could only deduct 800,000, and then the 200,000 would be taxable at your marginal tax rate. So it does increase your tax liability, but you're so far ahead as far as cash flow. It makes sense to go ahead and look at it. So that's the end of the presentation. I can go ahead and take questions.
Okay, if anyone has any questions, feel free to put them in the Q&A or the chat. I haven't seen any come through just yet, but
Okay.
it's probably a compliment to you, Brian. Maybe you answered all the questions.
Want me to end the slideshow, Aunt?
Sure. Okay. Well, I see we still have our attendees, so maybe someone might be typing up a question.
Okay.
We may wait just another minute. That's wonderful. And if people do have questions, or when we post this online, and if they're watching later on from our YouTube page and they have questions, I'm sure I saw that you included your email address, so
Yeah,
they could reach out directly to you at the time, or to their accountant, of course.
Yeah. Feel free to reach out. I won't bail you, I promise.
Okay. Well, I don't see any. Let me double check here. I don't see any in the chat or the Q&A. So we may just go ahead and carry on. So, well, thank you, everybody. I appreciate those of you who could join us. And Bryan, again, thank you for your expertise.
Sure, thank you.
This is a great example of where we hear from members that they want to hear about a topic, and then we reach out to one of our subject matter experts and deliver that topic. So this is exactly the type of thing that Chamber loves to be able to facilitate. So we appreciate your time in preparing and sharing your expertise today.
Yep, thank you.
Okay, thank you.
Uh-huh.